Hey everyone, welcome back to my channel. It's Nasdaq with Arshia. Today we're going to be discussing the differences between an IPO and SPAC, and we're going to be also discussing the definitions of an IPO and SPAC. And later on, we will discuss why a SPAC is more preferred and more simple over an IPO. Before we begin, I just want to say that I'm not a financial advisor, and I highly suggest you do your own due diligence and research before taking part in any investment scheme. Let's get started. So first, what is an IPO exactly? So IPO stands for Initial Public Offering. An initial public offering refers to the process of offering shares of a private corporation to the public in a new stock issuance. Public share issuance allows a company to raise capital from public investors. The transition from a private to a public company can be an important time for private investors to fully realize gains from their investment, as it typically includes share premiums for current private investors. Meanwhile, it also allows public investors to participate in the offering. And companies must meet requirements by exchanges in the Securities and Exchange Commission, or SEC, to hold an IPO. IPO provide companies with an opportunity to obtain capital by offering shares through the primary market. Companies hire investment banks to market, gauge demand, set the IPO price date, and more. Another key thing to note is that an IPO can be seen as an exit strategy for a company's founders and early investors, realizing the full profit from the private investment. So basically how this works, how an IPO works, is that before an IPO, a company is obviously considered private, right? As a private company, the business has grown with a relatively small number of shareholders, including early investors like the founders, family, and the friends, along with professional investors like venture capitalists or angel investors. When a company reaches its stage in growth and process where it believes it is mature enough for the rigors of the SEC regulations, along with the benefits and responsibilities to public shareholders, it will begin to advertise its interest in going public. Typically, now this always doesn't happen, but this is like typical. So this stage of growth will occur when a company has reached a private valuation of approximately $1 billion, and this is often known as unicorn status. Don't ask me why. However, private companies at various valuations with strong fundamentals and proven profitability potential can also qualify for an IPO, depending on the market competition and their ability to meet listing requirements. It's essentially a big step for a company as it provides the company with access to raising a lot of money. And IPO shares of a company are priced through underwriting due diligence. When a company goes public, the previously owned private shared ownership converts to public ownership, and the existing private shareholder shares become worth the public trading price. So moving on to what is a SPAC. So what exactly is a SPAC? So SPAC, or a special purpose acquisition company, have raised record amounts in the last few years. But SPACs actually have a simple model. They raise funds from the public markets, then find a company to merge with. When they announce the merger, shareholders can either accept stock in the new company or redeem their shares at the original price of the offering. So, to the SPAC issuer and the company they merge with, the SPAC is a deconstructed IPO with a very short roadshow. In theory, you could just negotiate with one investor, or with a few SPACs as you try to attract the highest bidder. To the SPAC investor, it's a subpar money market fund with a Kinder Surprise Egg style option attached. Invest, and for the cost of tying up your capital for a while, you have the option to get, well, something. Nikola, DraftKings, and Virgin Galactic all went public through SPACs. And we also know that there's been a recent blizzard of SPAC deals. Coupang, Lucid, and so many more. And finally, we will discuss why an IPO is less preferred over a SPAC. So a SPAC is basically very short and very quick. It can happen within 1 month or 2 months. It doesn't take a while to raise money. and to announce a merger. But an IPO takes a long time just to register, just takes 6 months just to register. It's quicker, and plus SPACs give more profit than IPOs. So that's all for today. Thank you guys for watching this video. I hope you enjoyed this video, and if you found this information helpful, please be sure to like and subscribe and leave your thoughts in the comments below. See you in the next video.